Good morning, everyone. Good afternoon around the world, maybe even good night. It is my immense pleasure to introduce the first ICISA Trade Credit Insurance Week to you. And what we have in the course of this week during 9 sessions is a variety of topics, a variety of extremely high-profile speakers, which we're so happy to have, and all with one goal. Our business, trade credit insurance, whether we approach it as underwriters or brokers or clients or regulators or whatever, is not the best known product in the world. But it is a very important one in terms of total economics. This is why we want to bring it to you and are so happy to see that we've got well over 2,200 registrations for this week. So what I would invite you to do is to watch as many of these items as possible. Very diverse topics. This one about public perception, but we also have one, for instance, about ESG aspects, where we've got a very distinguished speaker, the chair of EIOPA, Mrs. Petra Hilkema. And we have an extremely important session on how our industry is evolving and suiting the needs of our clients. With that, I would like to hand over to Dipesh. Dipesh Patel is the editor of Trade Finance Global. He is a total television personality. You all will have seen him at some point before and is extremely knowledgeable about our products. So Dipesh, take it away, man.
Thank you. Thank you very much, Richard. My name is Dipesh Patel, editor at Trade Finance Global and host of the podcast Trade Finance Talks. And also, Richard, we're delighted to be proud media partners at ICISA's Trade Credit Insurance Week. And today's topic is very important given recent events and also as a blueprint for the future of trade credit insurance. So in today's very exciting panel, we'll be exploring how the public sees trade credit insurance, if at all, and also how the product stimulates the economy as an engine of global economic growth. But right now, it seems as though when the credit insurer pulls, the case hits the papers. So what's actually happening? Now, whilst I introduce the panel, I'd like you as the audience to think about in percentage terms how much the world's traded volume is supported by trade credit insurance. And unfortunately, polling is not available, but if you can respond in chats, throw out some numbers in percentage terms, and we'll go back to that question later. Now, we have a really brilliant panel coming from 3 very different but very important angles: the view from a credit portfolio manager, a reinsurer, and a broker. So I'd like to welcome Tim Smith, Tamar, Julia, and Thomas Lallinger to the panel. And in no more than 30 seconds, I'd like you all to give a quick elevator pitch. So who are you, where are you from, and what do you do? Tim, over to you to start.
Yes, thank you, Dipesh, and thank you for the invitation. My name is Tim Smith. I have been a trade credit insurance broker for just over 38 years. The last 35 years I've been with Marsh. I'm currently the global leader, but I have historically worked both in Asia and run our Asia business and our Europe, Middle East and African business.
Thanks, Tim. Tamar, over to you.
Yes, thank you. Thank you for the invitation also. So I've spent most of my career in credit, in banking, whether it is in lending, in trading, and in credit portfolio management. And I was at that time also at the board of the IACPM, which is the International Association of Credit Portfolio Managers, gathering bank portfolio managers as well as insurers and investors, which are helping them in protecting their loans. I am now senior advisor at the IACPM.
Thank you very much. Thomas, over to you.
Yes, hello to everyone. My name is Thomas Lallinger. I am Chief Executive Financial Risks at Munich Re. And as you can see from my background, I'm located in Munich, the current world capital of Oktoberfest. I have around 10 years experience in primary credit insurance and more than 20 years of experience in credit and surety reinsurance. Yes, thank you very much for inviting me to that panel.
Thank you all. So we're going to split this up into a few different parts. Firstly, talking about the public perception of trade credit insurance. Then we're going to talk about its awareness and who uses it. We'll talk about some of the high-level trends and usage of trade credit insurance, followed with how the product can help from an additional funding or growth perspective. And finally, we'll explore, does the umbrella opens when it rains, and is the product working, and are we seeing growth of the product? So to start off, public perception. Tim, let's start with you. What's your view on the public perception of trade credit insurance? And perhaps let's split this right out into users and non-users of trade credit insurance.
Sure. Okay, Dipesh. Yeah, I mean, I think it's right. You do have to split it. Those companies that use trade credit insurance have an insight into some of the many benefits of the product, which include not only as a risk mitigant, but also as a credit risk management tool, access to third-party information and underwriters who are willing to support the growth of their business, both big and small. And I think that has been well seen over most recent years through COVID, that there has been an element of support through what has been for all of us, both unprecedented and also unimaginable circumstances to continue to trade both globally and within your own country. So I think most users of credit insurers has seen those benefits, and they have been duly supported by most of the underwriters through most of the COVID pandemic. However, as you alluded to, the opposite is also true of those companies that do not use credit insurance. A lot of headlines are seen on the newspapers around credit insurers cancelled cover on my key customer, or cancelled cover on my company, and now I'm going to fall into insolvency. And those headlines have some momentum, and they gain some momentum. I think awareness is rising, however, of the product. I think the external pressures of both inflation, rising costs of energy, and the general world that we currently live in are actually increasing the positive perception of the product. And even those companies that have yet to use it, I think, are looking more sensibly and probably more seriously at the product and how it might add value to their individual business.
Thank you. And Tamar, from the perspective of a credit portfolio management in banking, what's the difference between credit insurance and other risk mitigation tools?
Credit portfolio managers in banking are assisting the loan originators in assessing and managing their entire loan portfolio and remaining within the risk appetite, either at loan, at borrower, at product, or at portfolio level, and also to maintain within the capital that they allocated to the businesses. And therefore, they are using several funded or unfunded risk mitigation tools provided by capital market or provided by private credit investors or private credit insurers. And these mitigation tools can be provided at loan, at borrower, or at portfolio level. But as you know, banks are very constrained by strong and strict prudential regulations. So it means that as soon as they decide to mitigate risk at any level, at the loan, at borrower, or portfolio level, they want also that this mitigation cost is recognized and reduces the capital which is absorbed by the loan or by the portfolio. And therefore, CPM managers are using, between others, so private credit insurers, but they need to have CPI, which are equivalent to financial guarantees, meaning that it is not possible for the counterparty to cancel the contract in the course of the contract, as long as, of course, as banks are complying with their contractual obligation. And I would say that PCRI, private credit risk insurance, has two main characteristics. The first one, it is a private product. It is a product where banks and insurance are sharing information on the protecting borrower. And second, the relationship between the banks and the insurer is a partnership. So it's a partnership through the credit cycle. And insurers is a risk-sharing partnership. So insurers are protecting, we see from our surveys, a maximum of 40% of the credit facilities that they are engaged in. I would say we often hear from professionals or from regulators which are not experts in credit insurance, the question, where does the risk go to? And I strongly believe that the credit insurance industry would benefit a lot from being clear and explaining better how they manage risk, how concentration are limited, why the industry is less systemic than banking, and how they reinsure also the tail risk to co-insurers. It is complex. We know it is complex, but being more transparent, that I think would certainly help a lot.
Thanks, Tamar. And what are the most popular tools right now for risk mitigation?
Currently, for portfolio management, the most popular tools are at loan level, of course, loan syndication, loan sales and participation, and of course, credit insurance. Then at borrower level, it is credit derivative, of course. And at the level of portfolio, it is securitization, synthetic or through sale.
Thanks very much for the insights there. So let's talk about the awareness of trade credit insurance, and Thomas, as a reinsurer primarily dealing with underwriters, do you think there is a public perception of trade credit insurance? And do you think this is focused on perhaps corporates versus bank users of the products when the umbrella that doesn't open is mentioned?
Yes, certainly. I would say, first of all, this umbrella sentence is mainly coming from corporates that are at a certain point in time disappointed about the level of coverage that trade credit insurance are granting them, because it doesn't match what they expect to have now. But we have to remind one thing: credit insurance, unless other insurance lines of business, credit insurance is first and foremost a risk mitigation tool and not a loss paying tool. So therefore, managing the credit default ratio of clients is the core competence of the credit insurance company. Of course, the credit insurance company in the same moment does also manage their own loss ratio, of course, but nevertheless, it's a tool. And I think it's logical that in times of economic turmoil or downgoing economies or other critical events, that then the coverage for certain companies, for certain risks, must be managed actively. And this might comprise a reduction of the credit limit or even a cancellation of the credit limit. But this is a natural part of the tool, and that's, to my perception, also why companies buy this tool, because they want an objective opinion about the creditworthiness of their buyers now, from the corporate perspective. And we should not forget the second aspect. Many topics that are usually not seen in public, they make their way to the news when there is some criticism, problems, negativity around now. But usually you would never read an article in Financial Times or wherever about a happy buyer of credit insurance. No, this doesn't exist. Now you read articles about people saying, oh, okay, this doesn't work for me, or they don't do what they should do, etc., etc. So I think we shouldn't forget this aspect as well when we talk about public perception. And in my opinion, the perception at governmental level, for example, is very positive, because we have seen now in the Corona crisis and the aftermath of Corona that governments, they really had a look at trade credit insurers and were supporting trade credit insurers massively with different tools in order to help them maintaining coverage. And this sees that the public perception, let's see, on the governmental level, is quite a positive one, and they have recognized the importance of trade credit insurers and trade credit insurance for the economy. So I think that was a very positive feedback.
Thanks very much. And let's explore some of those wider trends for the usage of trade credit insurance. And Tamar, I know the IACPM is handling surveys on the usage of the credit insurance and CPRI by credit portfolio managers in banking. How is credit insurance used, and how does it differ from other tools in risk mitigation? You know, are the products solely used for single name credit risk transfer or capital relief, or a bit of both?
But we see that the attractiveness of credit insurance is growing over time, is growing over year. Of course, the European banks are generally more advanced than American banks in the usage of that, because we don't have as deep capital market than in the US. But the attractiveness of PCRI, I think, is mostly driven by 4 topics. The very first one, it is protecting the risk at loan level. So, and for the real losses. So it means that there is no mismatch between the risk that the bank does have on the facility and the protection that they receive from the credit insurer. The second reason is that it is not a financial market product. So it is not mark to market. So next to the no mismatch between the risk which is protected, there is also no accounting mismatch, meaning the loan which is accrued and the protection that would be marked to market if it was, for example, a credit derivative. The third reason is that it is accessible for protecting what we call illiquid borrowers, so borrowers which have no access to capital markets and which have no credit derivative to protect them. And the very last reason is that it diversifies the counterparty risk for credit portfolio managers because it accesses the insurance industry, which is another industry than the banking industry, which is protecting for the type of protection or for the pension fund industry or other industry. What we see that PCRI, so private credit risk insurance, is the second most important tool used by credit portfolio managers in banks after, of course, loan syndication, and just before synthetic securitization in Europe and just before sub-participation in the Americas. And when we ask them why they do use these products, the very first goal is to increase our lending capacity at borrower level. So it is really to provide an additional channel of risk distribution that allow them to increase their lending capacity to good borrowers, so borrowers that afford to receive these loans, but simply it is too much for the bank, in the risk appetite of the bank. And the second reason is to release capital, to release regulatory capital. So the fact that the CPRI give access to protection to illiquid borrowers is really critical. It is really that which make it very different from the other ones. We do see that I can provide later some ideas about the average rating, but on average it is 50% investment grade, 50% non-investment grade. It is unrated and illiquid in most of the cases. So CPRI fulfills really a unique function in credit risk mitigation for banks to support core lending as well as specialized finance. And again, European banks are more advanced because they've been using this product for more years. They are underwriting more transactions on a yearly basis, and what we do see simply that the product is growing.
Thank you. And question to the audience: if you do have any questions or comments, please pop them down on this webinar, and I'll endeavour to answer them. Tim, your market portfolio has grown substantially over recent years. Do you concur with Tamar? What's driving credit insurance usage from your client's perspective? Is it risk mitigant or is it to secure liquidity? And has this trend changed over the recent months given the current macroeconomic climates?
Yes, certainly. Certainly, I agree, and totally. I think it's all about liquidity, and we have seen over the past years, and certainly prior even to the pandemic, that a number of companies need additional funding, additional support, and they are going to banks with this product as collateral against their receivables portfolio. We've also seen, I think, through the pandemic, through the last 2 to 3 years, huge government intervention support. And some companies that were formerly deemed to be zombie companies, they were trading in almost illiquid or insolvent situations. I think they've now, through this period, built something of a war chest of cash, some better than others. But despite that, the liquidity needed to trade in the current environment, the liquidity needed to overcome some of the hurdles that we are about to see with the economic changes, with the energy crisis, et cetera, companies need to have that backstop. And I think a number of huge global organizations, multinationals, individual corporates, and SMEs are all looking for banks to try to find that additional source of funding. And this product is used wholeheartedly to support that liquidity. You're correct, our book has grown dramatically in the past 2 to 3 years. And I would say more than 2/3 of that portfolio has grown specifically to support additional funding.
Thanks. So it really is a liquidity piece there. Thomas, what's your view from a reinsurance perspective?
Well, as a reinsurer, of course, we mostly share the view of our clients, of the primary credit insurance companies. I would say the worthiness of the tool is, as I said, in the risk mitigation aspect and not in the loss paying aspect. So therefore, we mainly see, of course, the most volume of our clients comes, of course, from the corporate side, definitely. But as you all say, and as you all know, the volume of banks buying some form of trade credit protection is growing very rapidly. This is driven by regulation, and the need of corporates is mostly driven by risk management needs, of course. And therefore, as the regulation gets tighter by region, this volume is supposed to grow quite significantly during the next years, and we observe this, of course. What we see in both areas is that also the corporate side and also the banking side, they are both growing, and especially the corporate side is growing also throughout the crisis. Of course, you can observe that the credit limits are being reduced or even being cancelled. But on the other hand, credit limits in other lines, in other industries for risk coming from other industries is massively growing. And we see very large accumulations on different names, for example, that are now coming to a level where we really have to manage these levels as well, because some of the traditional risks, so of the clients of the insureds, they due to mergers and their market dominant position, etc., become such large credit risks that this volume must be handled by the primary insurance market and also by the reinsurance market really well together. And that seems to be one challenge that we see in the next year. This is less on portfolio solutions, of course. This is more in single risk solutions or single risk accumulations, but also in portfolio topics, we see accumulations that are really fastly growing now. So the broad base of the market is absolutely fine and well diversified, but the peak risks will become a challenge in the next years, to my opinion.
Thank you very much. And just to go into more detail on that, Thomas, how can the product help from a funding growth perspective, especially for corporates that are perhaps rated as BB or below?
I mean, rating is always a big parameter for the level of a credit limit that you can grant. No, I mean that's clear. So therefore, I'm not sure whether they can really help in funding the business, but of course, transparency is a very important topic for a credit insurance company when they are vetting the risks that they are insuring. No, I mean a high level of transparency, and good management and solid figures. No, how much can a quite lowly rated company do to increase the credit limits that this company is having with a credit insurance company, for example, or a bank? No, I mean that's always the same. And therefore, I think this topic is very much in hand of the risks in order to become good risks or better risks. No, I mean I don't see any other mean. No, you have the typical tools, of course. You can share much more of the risk by higher self-retention of the insured. Things like that. No, there are also some flexibility from the side of the credit insurance companies. Helps very much. No, you can give a higher limit when you have a 50% self-retention than when you only have a 10% self-retention. No, I mean that's very clear. But on the other hand, the insured amount is then also reducing. No, so therefore, I mean that's very much also a kind of question on the flexibility of the products that you are buying, or of the products that you are providing, being credit insurer. No. There's not just whole turnover, there's single name, there's even single invoice insurance. So you can really usually choose from a broad variety of products and solutions. So yeah, that's it. I mean, flexibility, and also from part of the risks. I mean, a risk that is objectively correctly vetted is a good risk or a bad risk. No. Yep. And from my times being a sales guy, I remember plenty complaints of insureds that they don't get a credit limit on a certain risks. But when then the credit risk underwriters were talking to the client and explaining why they didn't give a limit or such a low limit, in many cases the client says, "Okay, I understand this, no, and I don't want to deliver more than you would insure, because I understand your reasons and they are valid reasons also for me." So therefore, it's also maybe sometimes communication and transparency, as I said.
Thank you, Thomas. And I guess looking at the new reality, I'm going to ask a question perhaps for Tim, but Thomas also welcome to answer from Patrick Botts. Do we see credit insurance companies providing more risk scenarios on the new economic reality for industry branches, like reports on which industries and companies could be facing serious cash flow issues? Tim, perhaps I can ask you that question.
Sure, yeah. I mean, as Thomas suggests, it's all around analysing financial information. Do we see insurers writing more risk? Absolutely. Obviously, at the start of the pandemic, going into uncharted territory, which nobody had seen in the past, we saw underwriters become very, very cautious. And as it became apparent, again, through government support in many places, that there were actually a lack of insolvencies, a lack of losses, underwriters have started to reinstate cover and grow cover. I think now all of our primary insurers are at 2019 plus a percentage, and that percentage is 5, 6, 7, 8, 9, 10% more than they had in 2019. So there's definitely a growing volume of cover that is being afforded. Now, obviously, all companies are graded, and those with the higher grades are going to be offered more cover. And at the lower end, there will still be a lot of investigation, a lot of reviewing of financial information before the assessment is made. So there will always be a difference in whether a company is BB or below or AAA rated, of course. That said, I think the basic spread of an insurer portfolio is now quite well matched. Nobody is going to underwrite that very, very poor risk. And to Thomas's comment before about talking with credit managers, there is far more communication between insurers and clients at this stage than there has ever been, certainly in my almost 40-year career. And a part of that is understanding not only the necessity to deliver that credit, but also the need, the local need of a country, of a company, and of an individual supplier. So I think that understanding is becoming far more joined. So the insurer is no longer battling against a client that simply wants to sell. I think now most companies are more sophisticated to understand the need to have greater information to ensure their sale is specifically protected.
Thank you. Thomas, do you have anything to add to that, or should we go on to another?
No, I think that's fine.
Fine.
Just for your information, my PC wants to run a BIOS update, and it seems as I can't stop it. So if I drop off, I really apologize, but I try to handle it. Sorry.
No worries. Well, fingers crossed it doesn't ask to update and too soon.
Eventually, I would like just to add here that because we speak a lot about rating, but private credit insurance insure a loan, and a loan given to a BB borrower, it is secured. So banks don't grant unsecured loan like this. All these loans are properly covered themselves to protect the bank. So yes, it is true that we have more or less that most of the insured portfolio is within the BBB range. So at least 2/3 of the portfolio is in this area, and about half is investment grade, half is non-investment grade. But we see also an increasing share of credit insurance in all asset classes. So not only in corporate loans or in SME loans, which are generally, I repeat, secured by banks when they are in the lower rating level. It is not because you have a high probability of default that you have a loss at the time of default because of these security. But also we see now credit insurers entering the role in asset-based finance, in project finance, in infrastructure finance, and of course trade finance, but this is known from years. But they enter lending which are longer term, lending and which are more asset-based. I would say it would be interesting one day that the industry discuss, and just to say in the future of all these needs for finance that the industry will need, how do we want the balance sheet to be spread between the funding provided by banks, the funding provided or the protection provided by the investment industry, and the one protected by the insurance industry? But it is something that I think will probably take place at the EU level one day. But it is true that currently we have seen banks in the past in Europe which have 2/3 more or less of the share of the lending, but it is reducing, and we'll go to a profile that will probably one day be closer to what's happening in America.
Thank you, Tamar. Let's excuse me. Let's talk about whether the product's working and also whether we're seeing growth of the whole turnover product. And Thomas, I'll start with you. From a reinsurance perspective and also as a proxy for the entire market, where are the growth pockets for the industry, and where will we see substantial growth, do you think, over the coming years?
I think growth will. I leave apart inflation. No, I mean, this is clear that the growth in especially premium will come from the current inflationary environment. I mean, that's very logical. Secondly, I would say growth mainly come from from companies that already buy credit insurance, because we see growth over the recent continuous growth over the recent years, and usually far above the general economic growth. No, but mainly we see that the market penetration of credit insurance is not growing as fast or as much as it would be nice for the industry, and conquering new segments would be a very, very important growth element. So there are many countries or regions of the world where you have a very low penetration, and you definitely need more awareness of credit insurance, but also more possibilities for the credit insurance company to thoroughly analyze the risk. Now, in many countries where you have a low penetration, it's also because the information situation, as Tim pointed out, it is quite difficult, and you can't really bet the risks that you are insuring now, and this is prohibitive for credit insurance, as we all know. Then I see a huge potential in the smaller and medium-sized market, where the traditional credit insurance companies have still quite low market penetration. I think this will be changing by digital sales and more higher digitalization also in risk assessment, and maybe also in claim settlement, that will enable companies to manage credit insurance policies or coverages that generate much lower premium than the ones they usually have, and that really allow to penetrate a market that until now, or for many, many years, even decades, has not been explored appropriately. So I would see growth also coming from there, but it's a fair task to really achieve this growth and to make it work profitably.
Sure.
Could I just add there, Dipesh, as well, because it's not just the whole turnover market. I mean, I think at the moment the whole turnover market is in excess of 70% of the global portfolio, but there is also excess of loss, there is also single risk, there is non-cancelable cover. All of these are products that insurers have developed over the past few years to be more supportive of individual corporates buying the product. And I think probably some of those products are not yet widely known or fully known, and everyone talks about the whole turnover market because it is predominantly a whole turnover market. But there is a difference both for financial institutions and also for individual corporates between those products, and therefore the pricing is also different. But I think all insurers learned from the financial crisis of 2010, 2011, the need to understand more about risk. And that really saw the demand grow of XOL and also non-cancelable cover at that time. That has a real worth and real value. And I think all insurers recognize that now as well.
And I think that there will be also, from a bank perspective, three other reasons why the market must grow. The first one is that Basel III is being implemented now. It is being legislated for banks, and for many banks it will increase capital requirements, so banks will have needs to release capital. But there are two other developments that are very important. The first one is, of course, transition lending. It is sustainability-linked lending, the huge requirement that will be necessary to support the transition. The investment industry can invest in green finance, but the transition will be financed by banks. And the huge need will have to be supported by insurers, notably. And what I do see also as an interesting development is the role that the credit insurers are starting to play also in securitization, in synthetic securitization. Why? Because to release capital effectively at the pool of loan level, banks are securitizing synthetically the portfolio of SMEs or corporate loans. And we see the credit insurers starting to play a role in the protection of the mezzanine or senior mezzanine part of these transactions, which is a great development because Basel III will also require that banks release more capital, meaning have a thicker tranche to be able to redeploy the same volume of loan when they securitize. And it is, of course, the investors which are used to invest in the junior or the junior mezzanine part do not have a lot of appetite for the senior mezzanine. And it is typically a great type of risk and return for credit insurers that can play there really a boost in the development.
Thank you very much, Tamar. So now on to the final kind of section. Does the umbrella open when it rains? And actually, I'm going to jump into one of the questions from Olivia St. Raymond. What would you answer to bankers or corporates that are reluctant to buy credit insurance because they find it too cumbersome to consume and monitor? And I think, Tim, perhaps you might be best to start off with answering this question.
Sure, yes. I mean, obviously, there are certain clauses, certain endorsements, certain rules that have to be followed to ensure the policy is run fully and that cover remains intact. But that is nothing beyond good credit management support. So if I was talking to a banker or even to a strategic corporate, a strategic partner, I think it's more than common sense, but it's more around having that credit management understanding of your whole business. So I wouldn't say the working is cumbersome. It is different, and there is a system and process that has to be followed. But certainly, in my experience working with banks, providing their RPA falls in line with the end user, the customer, the supplier's credit management systems, we've not seen too many difficulties. I mean, one of the points around does the umbrella open when it rains? I'd like to quote ICISA's own figures here, but between 2007 and 2021, 98% of claims were paid in full. So does the umbrella get taken away? In my personal perspective, I don't think it does. Is the policy cumbersome? Is it difficult to monitor? It is different, but it is not necessarily cumbersome. There are certain restrictions and certain rules that are required, but I would expect most corporates trading in the current environment would welcome that either support to their existing system or that adoption of their current credit management procedures to enable them to continue to trade at the levels growing as they currently are.
Thank you, Tim. And I guess another question on that perception piece, and perhaps Thomas or Tamar, you can answer this. Can we ask the panel if the perception of the product differs based on the features of the policy? For instance, is non-cancelable cover viewed differently to cancelable cover, or are users generally unaware of those distinctions?
Deepesh, I think Tim should answer on that question because he sees these discussions much more frequently than I do. I would like to have a couple of sentences on the last question, please, because sure. When you try to have an objective view on this umbrella doesn't open thing, then you should look at the general default rates in certain economies, no? And I mean, we are as surprised as our cedents are that the loss ratios in the recent 2 to 3 years were that low, given the perceived crisis coming out of Corona, no? But when you look at the loss ratios of the credit insurance industry and you look at the default rates in different countries that have proper figures on this, you see that there's a clear correlation between both, no? And when the default rates go up, then of course the loss ratios go up as well. And this would be for me a kind of not proof maybe, but at least an indication that the umbrella is opening when it's raining, because raining in that sentence means that the general loss rate, the general default ratios in countries, in economies are rising, and that the policies are corresponding to that. And that's what we clearly see in many or maybe even most economies. So I think an more objective view on this umbrella sentence would be quite appropriate. Thank you.
If I may, I would like just to add on that for any credit portfolio manager, whether they are in banks, in corporate, or in working for any institution, if they want to be able to protect their loan across the credit cycle, so also when the sky is cloudy, they need to have partners, and partners to which they offer portfolios to invest in across the entire credit cycle. And this is really quite important, and it is one of the features of this private market, notably the insurance market. And so we have never heard about banks using non-cancelable, so private credit insurance that they claimed about late or non-payment of claims. But it is a market for professionals. It is a market where it's a market for professionals, and which require expertise, and when you need to have dedicated change in your processes and in your system to be able to properly monitor and inform and comply with all your contractual changes. And so we see banks are investing. They have their own centralized teams, either in syndication or in portfolio management, to deal with all these particularities of the insurance, meaning defining secondary limits, managed KYC, confidentiality management. So all these specificities, it is a market for professionals that works for professionals.
Thanks, Thomas. Tim, over to you.
Thank you, Thomas, for passing that difficult question to me. I think the question was more around, is non-cancelable cover viewed differently to cancelable cover? And I think the answer to that is absolutely yes. And there are some insurers that specialize in non-cancelable cover, and their portfolio has definitely grown over past years. And I think, just to be clear, that adds a level of stability and security to a company to know that their key customers are fully covered for the next X months, normally 12-month period, sometimes longer. Yes, that does provide an additional stability, but it does not provide additional cover in the event that a customer decides to ignore everything going around them. So if the debt still becomes overdue, they still have to follow their credit management procedures. Having non-cancelable cover versus cancelable cover does not mean you can continue to trade when you know your customer is 2 steps away from insolvency. But it does provide a level of support, and it is different, and it is definitely valued in the market, and has certainly been a key growing product over past years. We've also seen new insurers to the market, and both our traditional and new insurers are looking at non-cancelable cover as a method to provide stability and security for those new purchasers of the product.
Thank you.
And one should add the fact that non-can doesn't mean that the limit will never be cancelled. No, it's not an immediate cancellation, but it works differently than the traditional one. But of course, non-cancelable has an end. No.
No, absolutely. So I guess more of a future looking question here from Patrick Boss. Are we expecting a new round of state support by European governments for credit insurers to guarantee continuation of business? And Thomas, perhaps if you can answer that to our attendees.
Sorry, I was in the chat. Could you repeat?
That's all right. Are we expecting a new round of state support by European governments for credit insurers?
Okay. Yeah, I was just answering that one. Yes, definitely. Governments might come over the idea to do this again, but I would not expect most or all trade credit insurers to take up this opportunity based on the recent experience they had with these governmental aid schemes. Now, I mean, they all have paid money to the government, basically, in all countries, despite the structure of the governmental support. So I would say, based on the historic experience on these governmental schemes, and also based on the current low level of loss ratios for most credit insurance companies, especially for the global ones, I would not expect them to take up this opportunity, because as I said, governments might come up with the idea, but I would not expect this to have this having a second round.
Yeah, I would wholly agree with that, Thomas. I mean, I think there may well be European governments, some of the stronger European governments, who decide to support the energy crisis, but I think that would be different than supporting credit insurers. I think credit insurers have recognized over the past 2 or 3 years, whilst it was very good at the time to have the governmental parachute that most of Europe offered, it proved to be quite expensive looking backwards now. However, I also think you have to expect there are some European governments who simply could not afford to offer support again for credit insurers. And also, I fear that it's more likely to be industry-led. So we may find that the energy industry is supported. We may find those industry segments that have huge levels of employment, which would impede a government were they to fail, would get support. But I don't see European governments stepping up to protect credit insurers in the short term going forward.
I mean, what we see on the EU level since many, many years is the discussion about private marketable risks now, and then the decision of the EU in allowing the ECAs to cover risks that are usually private market risks. So this is also a very important tool to support trade and trade credit insurance, and this is being done since years. Let's say quite tacitly and well accepted by the private market. So this is differently from what they did the last 2 years, let's say, but this is working quite well and is an accepted tool.
Thank you very much. And I guess one final more technical question, which I think is quite interesting and we could explore from Dirk-Jan van Wijgen. Tim and Thomas, since decades, the rates on turnover have decreased considerably. On the other hand, the growth on the credit insurance market penetration has so far been very modest. What do you think are the main reasons for this rather odd situation? And Thomas, maybe we'll start off with you.
It's a great question. I would love to know the answer, basically. As I was typing in a chat, I would assume I don't see a decline of primary insurance rates, a constant declines in years. That has also taken place in recent years, definitely. No, I think rates have massively declined maybe 5 to 10 years ago, and they are now for most policies on a level where I would say far lower is hardly possible. No, so therefore I would say they have declined, but they are, from my perspective, stable at a quite low level. And when you couple this statement, no, which I can't prove it, no, but that's my opinion. When you couple this with the constantly growing trade volume that is being insured by the trade credit insurance, then the growth of absolute premium volumes might be the result. On the other hand, we also see a constantly growing exposure of credit insurance companies. So I don't know any larger credit insurance company where the exposure doesn't grow year by year. And as I said before, now we are in numbers, especially on some very exposed and very large risks. Just to say Amazon, for example, where really the market has to work together in order to cover the needs of the insureds on these single risks. No? But I would say low level but stable and growing trade volumes could be an answer.
Yeah, and for me, I slightly disagree insofar as I think we have seen soft markets probably for 10 years going into 2021. We then saw some stability and we started to see a hardening of the marketplace. But pure competition, I think, has kept markets flexible. We expect now, going towards the Q4 in 2022 and going into 2023, that market rates will continue to harden, and we believe they are already stable. So I agree with Thomas on that part. Is it unusual that despite the fact that rates have gone down, the growth of the trade credit market penetration is still low? Yes, I think it is unusual. But I do think with every crisis comes a sudden surge of interest, and with events like this will become a new knowledge of the product. I think we all have to be smarter about how we market the product, how we encourage new companies and financial institutions to look at the product. And only then, I think, will the penetration actually start to increase. But is there a direct correlation to premiums reducing and penetration? I'm not sure there is.
I think that standardizing documentation is also an important challenge that is being addressed now, but will certainly help a lot in simplifying the implementation of credit insurance.
Great, thank you very much. And I'm afraid that's all we've got time for. I'm sure we could go on for a lot longer, but I'm really looking forward to the rest of Trade Credit Insurance Week. So with that in mind, I'd like to thank Thomas, Tim, and Tamar for joining on this excellent panel on the public perception of trade credit insurance, and I think it's safe to say is most certainly the umbrella that does open. So thank you for demystifying and clarifying some of those as well as the real benefits of trade credit insurance on global economic growth and global trade. And actually to the question I posed right at the start of the panel session, 15% of global trade is supported by trade credit insurance, according to the recent ICESA stats. So thank you very much, panel. It's been such a pleasure. And Richard, back over to you.
Thank you very much, Deepesh.
Goodbye. Thank you, buddy.
So thank you all very much for your attention. Let me first add my thanks to those of Deepesh. I think Tamar, Thomas, and Tim have done a wonderful job. But last but not least, Deepesh has done a very, very good job bringing together diverse points of view from across the panel. Now, this was only the first in the Trade Credit Insurance Week this week. And we're going to carry on this afternoon, and this is a shameful advertisement for this afternoon session, which talks about why financial institutions use trade credit insurance, challenges, changes, and opportunities. And what you see is a real treat when it comes to the moderator and the panel members. Again, so to highlight some of the people, Audrey Zook is a director of A to Z Risk Services and probably one of the authorities on this in this field. We have Anil Berry, a board member of Allianz Trade, and for instance, Marilyn Blattner-Hoyle, who recently joined Swiss Re from the banking community. Amongst others, right? Jean-Maurice, Laurent, and Katie are well worth listening to. So I look to see you all this afternoon at 3 CET. Yeah, let me make that more specific. For 2 UK time, 9 a.m. Eastern time when our American colleagues will be awake. And I saw some Melbournians online this time. It's only 11 p.m. for them, so that should be possible, right? Mm-hmm. In the meantime, I wish you a very, very good day and hope to see you in a couple of hours. Thank you very much.
Thank you, Richard.
Thank you very much. Goodbye to everyone.
Goodbye.